Okay, Assalamualaikum and good afternoon, everyone. So for today's lesson, I'll try to cover 1.5 topics, I can say. But we will go through topic number 4 first. Okay, topic number 4, which is economic and industry analysis. And then we will try to cover as much as possible for the 5th topic, okay, company analysis. Okay, let me share with you slide. Okay. So even though this topic number 4 is quite lengthy in nature, but I will just touch on a few things, right? Because mostly in topic number 4, it's all about theory. Okay, so I'm gonna touch only on the important parts, and then from topic number 4, I will go straight away to topic number 5. Okay, like I said, I will try to finish as much as possible for topic number 5, but I'm sure we will not have time to cover everything for topic number 5. Okay, so for topic number 4, we will discuss about the analysis. When we want to do investment, okay, we want to choose the investment. So we have to do a few types of analysis. So for topic number 4, we have 2 parts here. We have the economic and we have the industry analysis. All right. So basically in investment, we're going to have 3 levels of analysis. Economic being the highest level, and then industry in the middle. And actually, we have another one, which is company analysis. So the company analysis will be discussed in topic number 5. So topic number 4 and number 5 is actually interrelated between the two. Okay, topic number 5 will complete the whole structure of analysis with regards to investment. Okay. So if you remember the investment decision process, one of the things that we need to explore, okay, one of the indicators that we need to know when we want to make decisions, obviously we need to determine the required rate of return. So this is from investors' point of view. Okay, this will be investors' required rate of return. So as an investor, okay, everyone might have a different required rate of return depending on individuals. Okay, some might have a low, medium, or even high target for required rate of returns. So by determining this rate of returns, then we can evaluate which investment will be suitable for the investors, all right, in ensuring meeting this required rate of return. Okay, so for investment decisions, okay, the common things that we're gonna look at, okay, when we want to compare, okay, the potential required rate of return with the current price of the securities is by calculating what we call as the intrinsic value. Okay, so this would be our measurement, okay, when we want to decide the value of the investment. Right, so intrinsic value, usually we will label as IV, intrinsic value. Also have a few names or synonyms, I can say, for the intrinsic value. So sometimes besides intrinsic value, this is also can be called as the real value. Okay, the real value. Sometimes it may be called as real intrinsic value, today's value. Okay, and another one maybe I can add, I put it here like fair value. Okay, so all of these terms relates to the same thing, or refers to the intrinsic value. Okay, so this intrinsic value is something that we need to analyze. Okay, it is not known. If we don't do the analysis, we will not know the intrinsic value. This is not the market price. The market price is whatever the price currently available in the market. Okay, if you look at share market, katakan, You can see the market price there, and that market price is the price that you have to pay in order to purchase, the investment. But the intrinsic value will be analysis value. And this intrinsic value, then we compare with the price, whether the price is what we call as suitable or not, okay, before you decide whether you want to buy or not the investment. So therefore, we need to compare between the two. So I can put here, for example, the intrinsic value versus market price. Okay, so we will compare these two values. So the market price, like I said, usually available in the market. Okay, we can check the market price currently. What would be the selling price? Okay, but the intrinsic value, we need to do the analysis. So there will be three possibilities, okay, with to the intrinsic value. Number one, if the intrinsic value is higher than the market price. Okay, so if the intrinsic value is higher than the market price, remember, IV, also known as the real value, today's value, or even fair value. So this is the so-called the actual or the correct price, supposedly. Okay, this is the fair value that we should purchase based on that price. Okay, so if this intrinsic value is more than the market price, okay, meaning the market price is lower than intrinsic value, right? If I switch the position, so IV is higher than MP, meaning MP is lower than IV. If the market price is lower than intrinsic value, meaning this market price is cheaper than intrinsic value, right? So therefore, if this is the case, this situation, we call that as undervalued. Okay, undervalued, because the market price is cheaper than the intrinsic value, meaning we can buy the instruments or the securities at cheaper price than the real value. For example, currently one stock selling for 2 ringgit, for example. Okay, let's say currently one stock selling at 2 ringgit per share. Okay, currently. And when you do the analysis, we have some calculations to do in order to find the IV. Let's say once you do the analysis, you found out that the intrinsic value is 2 ringgit 80 cents. This is the real value. Okay, so-called the real value. That's the actual worth of the investment. And since market price is only selling at 2 ringgit, so this is cheap, right? Cheaper than the actual value. So therefore, this is what we call them as undervalued situation. Okay, undervalued. So if it's undervalued, okay, we have two scenarios here for undervaluation. Yeah? It depends whether you are buying or you want to sell your investment. Okay, there are two positions, whether you are a buyer or you are a seller. Okay, as an investment, you don't buy or you don't invest forever, right? There's a point you need to sell your investment. Okay, you need to liquidate your investments. So you have two positions, whether you are in a buying positions, meaning you don't have the investment yet, but you want to invest, or as a seller, you want to liquidate your investments. So if undervaluation ataupun undervalued, okay, during undervalued, undervalued, as a buyer, as a buyer, this is a time for you to buy. Okay, because it's cheap, right? The real price is 280, but you can buy in the market for 2 ringgit. So this is undervalued. So therefore, our decision is to buy the investment. Okay, if it's undervalued, but for seller, right? Will you sell when the price is cheap? All right. So your decision should be hold. You will hold the investment, meaning that in other words, you do not sell. You just keep the investment until the price goes up in the future. So for time being, it's not recommended for you to sell your investment because it is undervalued. The price is cheap in the market. Okay, so the recommendation should be you just hold for your investment. Okay, so that's for undervalued when the intrinsic value is higher than market price. However, if it's the other way around, meaning if the intrinsic value is less than the market price, okay, meaning the real value is lower than the market price, meaning the market price is selling at a premium, okay, more expensive, right? So this is what we call as overvalued. Overvalued. So meaning the market price is much more than the intrinsic value. Right, so just for the sake of illustrations, for example, again, there's another stock also selling at 2 ringgit in the market, right? But when we do the analysis, we found out that the real value is only 150, for example, 150, 150 cents. So imagine one thing is, suppose the value is 150, tapi in the market they sell for 2 ringgit. Will you buy? Obviously not, because the real value is only 150, but people sell for 2 ringgit. Why we need to buy at 2 ringgit? Supposedly the price is 150. So that's why it's called overvalued. Okay, so if it's overvalued, OV ya kat sini tadi UV undervalued, OV is overvalued. So as a buyer, right, as a buyer, your decision should be do not buy lah, because it's expensive. Okay, do not buy. Okay, as a seller, so this is the time for you to sell. You will sell during overvalued market. Why? People pay more for this. Okay, because you can sell even though the value is just 150, but people willing to pay more, 2 ringgit in the market. So if that's the case, that's the time for you to sell your investment. Okay, so this is the decision tool that we're going to use when we want to decide on the investment. Okay, by looking at the intrinsic value. So later on, when we do the company analysis, because the intrinsic value only can be found when we do the company analysis. For this topic, if you remember, this is about economic and also industry analysis. So economic and industry analysis is basically just as scanning the current situation of the country, of the industry. Okay, not specifically about the company. The company, we're going to look during topic number 5, which is the company analysis. But in this topic, you will see we have 2 approaches when we want to do investment decisions. Okay, we have 2 approaches, which is number 1 is known as top-down. The other one is bottom-up. Later, I will discuss. And one of the steps would be company analysis. That's why I still discuss this here instead of later in topic number 5. Right? But yeah, this is important for you to understand the concept of comparing the intrinsic value versus the market price for decision making. Okay, but again, remember, the calculation is 1 point, but you need to know whether you are in which position, whether you are buyer or seller, because it will give a different actions, right? Like for example, kalau overvalue, it's either you sell or you do not buy, right? But the other way around, kalau they're undervalued. So you need to know your positions and determine whether it's under or overvalued. So actually there's another point or another situation or another scenario. So we have IV higher than MP, we have IV lower than MP. There's another possibility whereby the IV equals MP. Okay. Okay, so for this, it is known as fairly valued. Okay, first we have undervalued, and then we have overvalued. And if the IV is equal to MP, it's known as fairly valued. So for fairly valued, we don't have any specific recommendation. Okay, it's either you hold or you buy. It will not give any meaning with regards to our decision, because basically we get back your costs, right? Because that's the fair price for that particular day. We will not get any returns actually. If you sell, you don't get any returns, and you may not get profit if you buy it now. Okay. So as I said, in terms of the valuation process, we have 2 approaches. Okay, the first one is known as top-down. Okay, top-down. with three-step approach. So meaning we have three steps. And we have bottom up, the other one, whereby the bottom up, we're gonna go straight to the point basically. Okay. So the three steps, okay, the three-step approach will be something like this. The first step is economic analysis. Okay, based on the name of the topic, you can see first we have economic. Number two, we have industry analysis. Number three, company analysis. All right. So 1 and 2 will be discussed here in topic number 4. And then company analysis will be discussed further in topic number 5. Right. So when I said the top-down three-step approach, meaning we're going to look from step number 1, go to step number 2, then we go to step number 3. Hence the name from top down in this manner. Okay, so meaning we're gonna go step by step. We not go straight to step number 2 or step number 3. We're gonna go through one by one. Okay, and for top-down approach, okay, they perceive that every level of analysis is important. Okay, every level is considered important. You cannot skip any of the steps. That's based on top-down. Okay, and for the second approach, it is known as bottom-up. So the name indicates the arrow lah. It's going bottom up. Right? Even though technically we see, okay, meaning it's in reverse, right? But actually when we do bottom-up approach, we just do based on this step alone. Okay, when we do bottom-up, we go straight to stock valuation. All right, without looking into details, the economic and industry analysis, because for bottom-up approach, they assume the performance of the company can overrule, okay, the economic or even the industry analysis. Okay, so there's no right or wrong approach in this case, but from theory point of view, we have two different school of thoughts. Okay, whether to use top-down and bottom-up. And obviously from here you can see, obviously top-down will be more thorough because you need to do a lot of analysis, and bottom-up is more, in terms of the simplicity, much simpler. Okay, and the similarity between the two, okay, is actually this step number 3. Because step number 3 will be used in both, either top-down or bottom-up. Okay, because for top-down, the company analysis will be narrowed down earlier, meaning in order to approach or to calculate the company analysis, we already decided, okay, which particular industry in which particular country that we will do the analysis. Okay, whereas if bottom up, we just pick randomly maybe, or based on news or based on certain study that you do, then you do the company analysis. But for top down, they will narrow down from economic to industry and lastly to the company. Okay, and as I said, the similarity between the two, both will do company analysis, but the differences will be the perceived importance, okay, of the economic and industry. For top down here, they perceive economic and industry analysis is very important. That's why they don't skip this. They will do this analysis, but for bottom up, they will totally ignore. Okay, so they don't perceive that economic and industry will be important for their analysis. Okay, so basically when we talk about economic and industry analysis, this is actually to cater for the top-down approach only. Okay, because bottom-up, like I said, we just do company analysis, which is topic number 5 alone. So I'm going to simplify or summarize what does it mean by top-down, the 3-step approach. Okay, so first we're going to look at the general economic influences. Okay, so usually when we do this analysis, when it depends on the investor, obviously, but let's say if you want to look at the general overview of the economy throughout the world, okay, usually you will set beyond geographical boundaries, meaning you have a certain amount of money, okay, so you will filter which country you want to invest. So when we talk about general economic, you might look at several countries, for example. Okay, several countries. And among the indicators, when we look at economic influences, obviously we have some indicators. So what kind of indicators? All right, we can look at stock index, for example. For Malaysia, for example, we have our very top index is known as FBM, KLCI, for example. This is our main stock index. FBM stands for FTSE Bursa Malaysia. KL Composite Index, Kuala Lumpur Composite Index. Okay, we have one of second. I remember. Let me share with you maybe. And right, so for FTSE, FBM, when I said FBM, is actually this is we say them as FTSE. It's not FTSE. It's FTSE. Okay, FTSE Bursa Malaysia, KLCI index. Right. And when I said constituents, it represents the companies listed under this FBM KLCI. So in Malaysia, this would be the top 30 companies in Malaysia as of December 2020 last year. Okay, and this list can change from time to time depending on the performance of the company. So basically, this represent the top companies, not based on any. The listing is not based on performance. This is basically based on alphabetical order. Okay, Axiata is not the best company in Malaysia, for example. It's just based on alphabetical order, but this will be the top 30 companies in Malaysia, right? From various industry. From Axiata is telecommunications, for example, CIMB Banking Group, right? We have BG, another telecommunication. We have Hapseng. Hapseng is property, right? Harta Lega. We have Hong Leong Bank, another bank. Okay, various lah. Some property, banking, telcos, consumer products, oil and gas companies, right? All from various even top glue fees here as well. So the performance of these companies, some of them may affected from the economy. Okay, maybe not 100%, but based on studies, it shows that when the economy is doing good, okay, it will affect rate to the companies. The company will perform better as well. So if the economy is bad, for example, maybe not all, but some of the companies may be affected. So therefore, the performance of these companies will drop as well. So there's some relationship between the two. So we can use that as a indicators. If the KLCI is going down, it indicates, if not big, somehow it will indicate that the economy is not doing well for that point of time. Right? So that's one of the indicator lah, based on stock index. But beside this stock index, we can look at other measurement as well. For example, we can look at, for example, GDP. Okay, GDP is gross domestic products. Okay, GDP is a national indicators lah. Okay, we can look at the rate of inflation, for example. Okay, a lot of indicators. I can use inflation. I can use the unemployment rate. Okay, all of these are indicators for any specific countries. So meaning from economic analysis point of view, okay, you're gonna list the measurement that you want to see. Okay, for example, the index, the GDP, the inflation, unemployment, and you list down several countries as your potential investment place. For example, you want to invest in multiple countries. One of them, obviously, let's say Malaysia, and then you want to invest in Singapore, Thailand. For example, you just focus on Southeast Asian country, for example. Myanmar, and one more, let's say Thailand, Indonesia. Okay, so we have 5 countries. So before you go into specific company, okay, because Malaysia we have a lot of companies, can. But before look into the specific company, you go to the country level first. So meaning out of these 5, check the current situation of the economy indicators and eliminate potential countries with bad economic situation. Okay, but for time being, maybe it's quite difficult because during the COVID-19 pandemic, most of the countries affected, obviously. Okay, but there's an improving trend. Okay, there's an improving trend lately lah. So yeah, you can track the performance, the indicators by looking at their index. Every country obviously will have a different index. Okay, for example, besides economic influences, sometimes from country, you also can look at the political stability as well. Okay, you have, for example, 5 countries in Italy. Okay, maybe, for example, out of these 5, Myanmar currently is not politically stable. Okay, there's a lot of, let's say, unrest in the people of Myanmar because of political instability. So therefore, it will indicate that, okay, obviously when political unstable, it will affect the economy as well. Okay, so from there, you can eliminate some countries that might not be attractive enough for investment. Okay, so that's our first step to overview the general economic influences by looking at several economic indicators. Okay. Next, once you have narrowed down the country, let's say out of these 5, you eliminate Myanmar one because political. Then let's say Thailand and Indonesia is not doing well, for example. Okay, you settle with these 2, Malaysia or Singapore. So next step is to look at the industry. Okay, we have multiple industries in the country, right? And you will segregate or identify which industries which will prosper during that time and which industry might suffer during that time. So again, now is the best time to see or to test the strength of the company during the pandemic. Okay, So for now, for example, during COVID-19, even though there's, like I said, there's a slight improvement, but very minimal, but at least we have some improvement. But still, there are certain industries still badly affected. So very obvious example, like I said, during COVID-19, the industry that suffer currently, mostly related to tourism. Okay, tourism, travel and tour lah. Travel and tour. So any industry related to, I don't know, airline industry, hotels, what else? Yeah, the all the tourism activities obviously will be affected, even though nowadays, like I said, they start to open up a bit, right? Especially for the domestic tourism, but still we cannot accept largely people from outside as compared to prior pandemic. We have millions of people coming in to our country, but after the lockdown, we totally limited the tourists. So therefore, tourism will be in this category. They suffer. So when you want to do the investment, you can remember all of this relates to our decision to invest. Okay, so therefore you will eliminate tourism. So the industry, whichever related tourism, you will reject. So will not be part of your selection because you've done your industry analysis. Okay. By the way, when we talk about economic dengan industry, we don't have any specific calculations. Usually we're gonna just list down the pros and cons. Okay, what would be the best industries to invest in, for example. So industries that still prosper, even though during pandemic, you know lah, companies related to food and beverages, for example, will always prosper because people will still buy food and beverages products, consumer products, something that we use on daily basis. So that company will not be affected even during this pandemic issues, even though might lower a bit their income, but their sales still will be generated. Okay, so from there, then you narrow down which industry is good, which industry will be bad for your investment. So once you identify the industry, maybe out of, I don't know, 20 types of industries, you narrow down only 5 industries from these 2 countries. Kalau 5 to rate you rasa banyak, you narrow down until 1 or 2 industries from these 2 countries. And from there, lastly, you do the company analysis. Okay, so this company analysis, like I said, will be discussed in topic number 5. And this company analysis will determine which companies will be selected based on the industry from step number 2. Okay, so meaning there'll be no company analysis done for tourism because you already exclude from your selections. And under the company analysis, like I said, we are doing the comparison of IV versus market price. And if you are the investor, we are looking stocks or investment which are undervalued. Okay, so that's top-down approach. Okay, if you reverse back to here, remember, they go from step 1 to step 2, step 3 without skipping any of the step. Okay, they value these first 2 steps greatly. Therefore, they do every single steps. But for bottom up, as I said, they will eliminate the first 2. They just go to company analysis. But for company analysis, obviously, it will be I can say random. You don't have any guide to choose which company to analyze. Takkan you nak analyze every companies in the country kan. So therefore, your decision making too will be based on either news. Okay, you read some news and indicate and read somewhere there's potential for this company because of the current situation. Then you do analysis for that company. So you disregard the country or even the industry. Okay, meaning when we do bottom up, there's a possibility that maybe, for example, tourism related companies still be analyzed by you. okay, because you disregard the industry influences. Because for you, even though the tourism may be affected, but this company have a special niche whereby people will still invest maybe in that particular companies. So does the three-step process work? Okay, in general, because as I said, based on academic study, okay, a lot of researchers indicate that there's a relationship, okay, relationship between economic indicators, as I mentioned tadi lah, like LCI, GDP, unemployment, inflation rates, okay, sometimes money, currency exchange, all of those will relate to the performance. Okay, performance can be measured using earnings lah, companies' earnings dari segi dia punya net profit, for example, or if they use ratio, they can use return on asset, for example, or return on equity, for example, and there's a relationship. Okay, they found a relationship between the performance, either profits, or they can use stock prices as well, with economic indicators, as I said tadi lah. We have employment, but usually we don't measure employment, we measure the unemployment. Okay, the higher the unemployment, the bad indicators for the country lah. Okay, kalau negara tu terlalu ramai, unemployed people, unemployed young adults, then it indicates there's no enough jobs for the citizens. So it's bad sign already kalau high unemployment. Income can be from GNI, General National Income. For GDP production, we have GDP tadi lah. GDP, kalau income, we have GNI, Gross National Income. So all of these are economic indicators. So from economic analysis, somehow it will go down to the companies. So that's why some believe that the three-step process, which is the top-down approach, is working basically, right? You can do this and might give you a better decision making, right? This one mostly ada cerita lah, economies. That's why I will not go into detail every single things here. Okay, in fact, I think I'll stop something in here. Okay, for bottom up, as I said, the difference would be we don't do this. These two will be eliminated. They just go straight to company analysis. So the similarity between the two, the company analysis, will be discussed now in topic number 5. Okay, topic number 4 tadi memang totally theory. Okay, but the things that you need to know is the difference between the two approaches, top down and bottom up, and how the analysis be done, especially for the first two. And now we're going to discuss the third step, which is the company analysis. Okay, company analysis. This is basically the third step of top down. Of top down approach. Okay, or the only step in bottom up approach. Okay, so that's company analysis. So from top-down approach point of view, so after you analyze the economy and also the industry, right, you compare several countries and you've decided to invest a portion of your portfolio in a certain stock markets in a certain industry, okay, after analyze the industry as well, right? So which is considered the best companies? Okay, are they overpriced? So we are looking back at the process of comparing IV versus MP, as I said earlier, right? To see whether it's under or overvalued. Okay, because some companies, or yeah, some good companies are not necessarily could be a good investment, meaning you do not invest in popular companies or companies with possibly uh, with high net profits, for example. Even though it is a good indicator, company with high net profit will be good investment, but sometimes it will be not the case. Okay, because sometimes the company's price, okay, can be overpriced, macam cakap tadi lah. Okay, because of high demand for certain stocks, the price may be higher from the expected values. So therefore, before you decide to invest, you need to compare. Okay, you need to compare the intrinsic value versus the market value or the market price. Okay, so before we go into the detail of the analysis, maybe it's good for us to recap, okay, the types of companies or the types of stocks available in the stock market if we are looking on the equity side on the stock market. So for the first type, okay, of company, we have what we call as the growth company. Okay, so growth company usually comes from a list of companies which is considered as new. Okay, usually when we set new, they have limited historical. Okay, limited historical data to analyze. Okay, so maybe less than 5 years, maybe, which is new company. However, one good about this company, they have potential. In fact, they have very high potential for the future growth. Okay, so historically, this company may have above average sales and earning. Okay, their income is good, their profits are good. Okay, like I said, but the bad thing I can say, when we invest in this kind of company, in terms of their returns to the investor. If you recall in our previous topics, as investor, you need two things. You need two types of profit. We have capital gain, and we also have income gain. And one of the income gain is dividend. Right? So for capital gain, no issue. These types of company may give you capital gain. Okay, but as I said, if you want to capitalize on the capital gain, you need to sell your stocks in order to get the profits. Okay, but for income gain, you can get the dividend. Okay, without selling your share. Okay, but obviously you cannot sell in order to get the dividend anyway. All right, but for these growth companies, their dividends usually will be low. Okay, high growth companies usually will give lower dividend. Why? Because of this. Okay, remember, where is the source of dividend payments? As a company, the dividend comes from the net income. Okay, the net income of the company, the net profits. Okay, also known as net profit lah. So if the company earn high net profit, for example, since they are a growing company, okay, the net income will be split into two funds. Okay, they will pay dividend to the shareholders, which is the investor like us who are looking for income gain. And the rest of the money will be reinvest in the company in the form of retained earning. Okay, so for these growth companies, usually their portion for dividend will be low. Okay, because they are growing, they need consistent or continuous capital injection from time to time because they are growing, and so they need capital. So therefore, one of the source of capital can come from net profits. So therefore, let's say if the company earn 1 million ringgit net profits, okay, out of this 1 million, maybe dividend they will pay 5 to 10% only, okay, out of this 1 million. So the rest of the money, okay, 90 to 95%, they will reimburse or reinvest in retained earnings. So therefore, as investor, will you or will us enjoy the dividend? Okay, obviously not, because the dividend payment is low. Okay, so therefore, as short-term investor, growth companies will not be suitable for you. Okay, not suitable for short-term investor, because short-term wise, they will pay lower dividend because the profits that they generate will be reinvested in the company for future operations in order for them to become bigger and more sustainable. Okay, so you have to wait. Okay, in order to get higher returns from this kind of company, you have to be patient. You have to wait longer in terms of high returns. So short-term wise, yes, you have to bear with low returns. Okay, but this company will grow in the future. Okay, if they can consistently produce good things, and once they stabilize their operations, and that's the time for you to receive higher returns. So for growth companies, it's more suitable for medium to long-term investors, not for short-term. Okay, so that's the first one, the first types of companies, which is growth company. The second one is defensive companies. Okay, so this type of company, defensive, um, their performance, okay, their performance usually can withstand the economic downturn. I can't find the word withstand in bahasa. Withstand in basically they can, what the word for Malay. Okay, basically they're unaffected lah. Bukan Malay, but yeah, simpler word of withstand is unaffected of economic downturn. Okay, so meaning even when the economy is going down, these companies will not going down together with the economy. In fact, they will either stay the same, or some companies may perform better during the economic downturn. Right? So for this kind of companies, usually related to public utilities company, or as I said tadi lah, companies related to grocery chains, because they are providing grocery items, right? Similar to supply basic consumer necessities. Okay, basically related to F&B lah. Okay, and F&B pun not the premium one. Okay, just the basic or staple foods maybe. Okay, items like companies related to production of rice, production of sugar maybe, because regardless of the economy situation, we're going to use this rice, sugar. Okay, kalau public utilities, maybe in Malaysia, we have companies like TMB, for example, for electricity. Okay. Companies related to telcos, maybe, because we still need communication, right? Internet. So these companies, we cannot say that they will stay strong, but somehow they will either stay the same, as I said, or they can perform better during economic downturn. So that's why they are known as defensive. So they will not go down together with the economy, because some industry when the economy is going down, their performance will going down as well. Okay, especially companies related to maybe luxury items. So during good economy, people have a lot of money, people invest or people spend their money for luxury items. But during economic downturn, people will stop buying because they are focusing more on necessities product. Okay, so they don't spend on unnecessary items. Okay, so therefore the luxury goods will be affected during economic downturn, for example. But for defensive, no, they will survive. So the rate of return will not expected to decline during overall market decline. So they will not go similar with the market trend. Okay, as I said, when the market going down, their performance either stay the same as before, or some of types of company may perform better. Another types of companies here may be companies related to gold, for example. Gold is another investment types which is considered as defensive, because when the economy going down, the performance of the gold usually will improve. Okay, that's the types of defensive product that can relate with the defensive companies. Next, we have cyclical. So for cyclical, this is the opposite of defensive, whereby defensive they will not go together with the economic cycle, but for cyclical, hence the name cyclical. They will go according to the cycle of the economy or the cycle of the business. Okay. So these types of companies will rely on the aggregate business cycle. So as a company, when we talk about business cycle, the cycle of business will go in marketing. I think you've learned in marketing, good, right? When they launch a new product in the market, right? They will sustain for a few months or for a few years, depending on products. And then the demand for the product will drop. Okay, so in order to go up again, they need to introduce new product. So just for example, mobile phones nowadays, mobile phones. What if, okay, Apple or Samsung release new model every 5 years instead of every year like now, even though every year maybe they just improve here and there and come up with a new model. But let's say they just produce new phone model every 5 years once. Okay, if they stop producing new model every year, their competitor, will take their market share. Okay, so therefore, for this types of company, we know already their cycle. Okay, they launch new product and keep it in the market for a few months. Okay, and the sales will drop somehow after 9 months maybe, because they know another 3 months they will release a new model and then the sales will go up again. So that is the cycle. Okay, so we have these kind of companies, which usually related to industry like steel, automobile, or even heavy machinery. So some consumer products also like that, like I said, like mobile phone company. Okay, so some maybe not every year lah, macam automobile for example, they may produce new model after 5 years maybe. They just add on or enhance a few areas for the refresh version. But usually automobile companies like in Malaysia, we have Proton, for example, Pro2, okay, which rely heavily on new products. That's why when you see when the company introduce new model, for example, Proton, like classic example, okay, their performance are quite bad for how many years, so long, and I can't remember, maybe 2 years ago, 3 years ago, they launched the new product in the market, which is the X70. Okay, the S70. So this S70, when they launch, the market interest going up because they have, yeah, basically are offering something cheaper than their competitors. Okay, their competitors. But now is the second or third year. So if they just rely on this X70 for the next 10 years, for example, without any refresh ataupun a newer model, this demand of X70 somehow will reduce in the future. So therefore, in order to get the companies to go up again, they need to relaunch a newer model. So yeah, they cannot rely on just one model throughout their history, for example. So that's why these cyclical companies will move up and down depending on the cycle of the business. Like macam kalau company relates dengan rice, for example, it doesn't matter. It will, either stable ataupun go up from time to time because of the demand is always there without having to introduce new products, for example. Number 4. Patutnya ada satu lagi lah, maybe kejap kita explain. We have speculative companies. Okay, so speculative companies is one of the highest risk kind of investment, stock investment specifically because the firms usually involved in activities or projects that are uncertain in terms whether can profit or not. Okay, because they have a great risk involved. Okay, for example, here, companies involved in oil exploration, for example, companies involved in oil exploration, whereby the chances to get or chances to find maybe new oil field is not something that we can find every day. Maybe once a year. It's also sometimes hard to find it. Maybe in 5 years, once or twice, they might find a new oil field. Okay, so this kind of company or types of stock are very speculative. So when I said speculative, usually the price movement will be high, okay, and harder to predict. So therefore, for investor who wants to invest in this speculative, they need to have knowledge to invest, obviously, number one, and know when to enter the market and when to leave the market. Because, as I said, the price stock for speculative, usually dia punya differences will be high, up and down there. So it's harder to predict when will be the lower and when will be the higher price. Unlike some other investment, for example, dia punya price movement tu in the middle, something like that. Okay. Okay, dia boleh increase, tapi dia punya movement tu is very narrow. Kalau ni, the big gap. So you cannot predict. So for this type of investment, you need to know when to enter when the price is low, and you know when to leave when the price is high. Okay, so actually there's one more, the fifth one. We call them as the blue chip companies. Okay, so blue chip companies is basically, kalau you tengok tadi IBM KCI, we have 30 tadi kan. So those are the blue chip companies. So what does it mean by blue chip companies? These are the top of their, meaning they are top ranking in their respective industry. Okay, if you notice earlier, we have companies like Maybank, Hong Leong Public, which is top in their banking industry. Then we have Axiata, Maxis, Digi in the telco industry and so on. So those are considered the best in their field. Okay, however, one of the downside for these blue chip companies, maybe not all, but some of the blue chip companies are expensive. Okay, the price is expensive. And sometimes it might be difficult to find seller of that stocks because people seldom will sell. Once they bought their stocks, usually they will keep it, right? And if you want to purchase, you have to pay premium. You have to pay more in order to get those stocks. Okay, so that's the fifth one. Okay, but in terms of in terms of returns, performance, obviously this would be the top of the cream, but the best if you can invest in these companies, blue chip companies, right? But the downside of it, it is expensive and hard to find. Okay, hard to find on the seller of the stocks. So this is something that we need to think of when we try to invest, whether to invest based on value or based on growth. Okay, because usually when we talk about value, this is more on short-term basis because this value is based on current, whereas growth is for something for the future. All right. So some stocks may have positive earning, okay, and perform above average, okay, and can be identified as undervalued, okay. And some value stocks appear to be undervalued because a lot of reasons, especially the potential of profits in the future or earnings in the future. So one of the indicator that we can use to see the valuation of stock by looking at PE ratio. PE ratio stands for price to earning ratio. Okay, so if you learn financial management before, I think you've heard of PE ratio, okay, price to earning, whereby the formula is market price divided by net profit of the company. So there are two scenarios. As an investor, as a buyer earlier, okay, beside the IV, we can use also PE ratio, whereby the lower the PE, okay, it indicates that the stock might be undervalued. Okay, low PE, this is undervalued. But if they have a high PE ratio, price to earning, it may indicates that the company is overvalued, right? So again, the same thing lah. For buyer, we want the stocks to be undervalued, but for those who already invested, they want their PE ratio to be high because that's overvalued. Okay. So we're gonna look at this part now, company analysis. Tidak. Okay, just give me a few seconds before I take a break. For company analysis, okay, you're gonna see we have two categories, okay, or two approaches in company analysis. Okay, this one already discussed the economic industry influences, right? So here are the approach. We have the first part here. This is more on qualitative aspects, okay, whereby we do the company analysis by looking at their qualitative strengths. Okay, what are the strengths of the company? What will be their weaknesses, opportunities and threat? Then you do the SWOT analysis. You've learned SWOT analysis before. Okay, whereby you match between their strength and opportunities. What will be their possible you can see technique, possible approach that we can take on the strength and opportunities. Then you can match between strength and threat. For example, how to manage their threats, how they use the strengths to eliminate, not the eliminate lah, meaning to reduce the impact of the competitors. For example, the threats. Okay, that's qualitative. So during the SWOT analysis, usually they will not take into account their accounts, maybe their numbers. They don't care about numbers. They are more on qualitative aspects. And I will not go into detail about qualitative aspects. Okay, because company analysis can look at this. Okay, but for us, we will focus on these valuation approaches. Okay, by looking at the present value of cash flow and we compare. So under the firm's valuation approaches, we have two methods. Okay, the first one is present value of cash flow or Usually we call them as one of them as DDM, dividend discount model. And we also will look at the relative valuation ratio. Okay, this is using ratio, okay, which is the PE ratio earlier I said. Okay, so I will not go into detail the Porter or the SWOT analysis. Okay, we're going to look at the valuation approach. But before we discuss about this valuation approach, maybe let's take a short break before we do the calculation section. Okay, so we are going to do the calculation section afterwards based on the valuation approaches. Okay, and this will be the first one. This one. This will be the first. This will be the second. So we're going to focus on this part here. Present value or dividend discount model based on the present value of cash flow. Okay, so let's take 5, right? So 5:35. I will give you 10 minutes lah. So we'll resume back at 3:45. Okay, for our firm valuation approach. All right, let's continue with the evaluation or the estimations for the intrinsic value. So, like I said, we have two models or two approach, okay? And both actually at the end, we're gonna identify the intrinsic value. Okay, this will be our measurement. And we will always compare IV versus the market price. I told you multiple times already for this one. Okay, and the intrinsic value, as I said, refers to the actual, so-called actual value of the security. So for the terms, as I also mentioned earlier, we have multiple terms. Okay, multiple terms like fair value, yeah, value of stock today, for example, present value. So all of these are referring to the intrinsic value. Okay, so even though they ask you, okay, find the present value of the stock or find the value of the stock today, they are actually referring to the intrinsic value. So we're going to measure it or calculate the intrinsic value and we compare it against the market price. Okay, and according to this approach, we're gonna assume, this is the assumption, that the IV will incorporate all the elements which is part of the brand name, the trademark, the copyright, everything will be embedded together with the intrinsic value. So meaning that IV will incorporate every other elements as part of the value itself. Okay. So this one I already mentioned multiple times. Okay, if the intrinsic value is more than market price, it is undervalued. Okay, so this is based on the role, whether you are buyer or seller for undervalued. So this would be the buyer. This would be the seller. Okay, so if it's the other way around, this IV is less than market price, it is overvalued. So as a not whole means, if the not whole means sell, right? So this is for seller. For buyer. So your decision should be do not buy. You do not buy. And as I said, if it's fairly priced, equals, there's no specific. It can be either one. You can choose either one. But for questions related to test, exam, quiz, assignment, whatever, you shouldn't get this lah. It's either undervalued or overvalued for you to decide. Okay. So the two approaches, like I said, we have PVCF, present value cash flows, and also relative. Even though we have multiple techniques, we're gonna focus only on one each. Okay, for the PVCF, we will just focus on the dividend discount model, DDM, whereby we will present value, okay, we will present value every dividends into today's price, okay. And the second approach, which is the relative valuation techniques, we're going to look at the PE ratio, okay, the concept of PE ratio. Okay, but for today, I think I will not go until PE ratio. We're going to focus on the PVCF, but under PVCF, you will see we have 4 different models. Okay, so maybe out of 4, maybe we have time until at least the third model, at least. I try to cover at least up to third model. The fourth model, I will keep it for next week's session together with the PE ratio. Okay. So under the DDM, the dividend discount model, we're going to, hence the name present value, right? We're going to present value. If you remember the concept of present value, it's something like this. Let's say this is a timeline. We have 1, 2, let's say 3 years. Okay, 3 years, and this is today. Okay, for the DDM or the discounted cash flow techniques, they will assume that you will receive dividends every year. Let's say first year 1 ringgit, second year you're gonna receive a dividend of 150, and then third year you receive dividend of 120. So when we said present value, we're going to bring this value for the first, second, and third year to today's value, hence the name present value. So we're going to bring this, all of this, to year 0. Okay, that's what it's meant by present value or discounted cash flows. And besides this dividend, 1 ringgit, 150 and 20, 1 ringgit 20 cents, these are all dividends. We're going to assume also that we will sell, okay, we will sell the stocks during the final year. So meaning, let's say the selling price is 20 ringgit. Okay, so these are the dividends, 1 ringgit, 150, 120. And we're going to bring this 20 ringgit selling price to today's value as well. Okay, so that's why we're going to present value the dividends. And also, actually, we're going to bring the selling price as well. Okay, this one. Okay, we have the cash dividend. This is based on expected, because this is all based on futures assumption, and we're going to assume also they will sell it in the future. So cash dividend, it can be 3 years, it can be 4 years, 1 year, even 2 years, whatever. Okay, we bring everything to today's value together with the selling price. And the combination of all, the sum of all values will be the intrinsic value. Okay, we need to add all of those into the intrinsic value to become the intrinsic value. And then we compare that value to the market price. Okay, so you will see a few formulas like so. Okay, but before we look at the formula, okay, in fact, I will use my formula as well. Yeah, I use that one, much easier to use. But under the dividend discount model, we have 4 separate models, as I said. The first model is known as constant dividend model. Okay, constant dividend. So what does it mean by constant dividend? It is a fixed dividend. Okay, every year you are expected to receive the same amount of dividend every year. For example, you receive 1 ringgit dividend every year. So that's constant dividend. Okay. The second model is the opposite of constant dividend is inconstant. Okay, inconstant dividend. Okay, constant. So constant dividend means the amount of dividend every year will change from time to time. Okay, example, something like this. This is an example of inconstant dividend from 1 ringgit to 150, then go up to go down to 120. Okay, so the movement is quite random, but it fluctuates from time to time. So that is inconstant dividend. Right. The third model is known as constant growth. In constant growth. So constant growth model means the dividend will grow from time to time, but at a specified growth rate. Okay, so just for the sake of illustration, for example, let's say currently the dividend is 1 ringgit. Okay, D0 means current dividend. Okay, and this company's dividend are expected to have a constant growth. So when we talk about constant growth, dia akan ada growth rate, which kita letak dia as G. Let's say the growth rate is 10%. So we will assume for a constant growth dividend, this 1 ringgit will grow 10% every year. So meaning, if today is 1 ringgit, next year, D1, this dividend, 1 ringgit, will increase by 10%. Okay, by 10%. And next year, we can expect to get a dividend of 1 ringgit and 10 cents. Because 10% of 1 ringgit is 10 cents, yeah? So next year, we will have a higher dividend, which is 1 ringgit and 10 cents. And these rates will remain constant. They will remain at 10% every year. So meaning if we want to estimate the second year dividend, D2, for example, D2. So this 1 ringgit and 10 cents from the first year will increase another 10%. So another 10% will be 121, for example. So they can keep on increasing with a constant growth. Okay, so this 10% will remain constant every year. Okay, and the fourth model is in constant growth. Okay, or sometimes we can call them as multiple growth. So this multiple growth means kalau compare with the number 3, constant growth means the growth rate remain constant. Okay, but for inconstant growth model, this growth will have different rates every year. Not every year lah. For multiple times, they have a multiple growth rate. So for example, year 1 until year 2, the growth rate, this is growth is 10%. Year 3 until year 4, 12%. Year 5 onwards, 15%, for example. Okay, so we have multiple growth rates. Okay, kalau the third model, we only have one, 10%. But for inconstant growth, we have 3 different rates, 10%, 12%, and 15%. So therefore, why we need to identify the models? Because the way we calculate might be different from one to another. Okay, so for today, I will not touch on inconstant growth yet. We will try to focus on the first, second, and third, because first and second, basically, the formula will be the same. We're going to use the same formula. Okay, first and second, we're going to use the same formula, but the third one, constant growth, even though it looks might look complicated, but actually the constant growth will be the easiest to calculate. Okay, because the steps is simpler. Okay, we have some formulas in the notes, but I simplify it. I can simplify it. Share with you. Okay. Right. So we're gonna use similar like in the note. we're going to use this symbol, VI. So VI refers to intrinsic value. Okay, intrinsic value of the stocks. Okay, so this is the first formula for the first model. Okay, and the formula would be based on dividend. D is dividend. We divide with K. Okay, D is dividend. And K is required rate of return. Okay, and for this formula, number one, this is only applicable to constant dividend model. If no selling price given. The question. Okay. Remember, if you remember the earlier part I said, under the discounted, the DDM, dividend discount model, you're going to discount, or you're going to find the present value of the dividends plus the selling price. Okay, but if there's no selling price, let's say if there's no selling price, like so, how we want to use the discount model, right? So therefore, only for constant dividend model, we're going to have an alternative, which is to use this formula. Okay, the intrinsic value is based on just dividend because the dividend is fixed, right? So whatever year, it will be the same. So dividend divided by K, required rate of return. Okay, this is our first formula. But most of the time, for constant dividend and inconstant dividend, you're going to use this formula instead. Okay, and this must have the selling price. Okay, so the intrinsic value will be based on dividend divided by 1 plus K. K refers to the required rate of return. D, dividend. 1 here means dividend for the first year or year 1. Okay, plus dividend for the second year. 1 plus K squared plus whatever dividend that we have. Okay, let's say if you have dividend until year 5, so meaning you're going to have D1, D2 plus D3, D4, and D5. Okay, for example. And I will end it with the end and represent the final year. Okay, the n divided by 1 plus K to the power of n. Okay. Alih ni je. Susun lah. Okay, because we have another element besides the dividend, you remember? We have the selling price. Okay, selling price divided by 1 plus K to the power of n as well. Okay, so this is the formula. Okay, remember D1 is not D0. D0 is current year. We are starting from D1 divided by 1 plus K plus D2 divided by 1 plus K to the power of 2. And then we add how many dividends we have in the questions until the final year, the n. I label them as the n. Let's say if you have 4 years, yeah, so it will be n with D4, 1 plus K to the power of 4 plus the selling price during the fourth year, divide by 1 plus k to the power n4. So this n and this n should tally, should be the same between the two. Okay, it should be the same. Right, and as I said, this is applicable to constant and inconstant dividend models. Okay, for the first two models, either constant or inconstant dividend, we're going to use the same formula. Okay, the same formula. So let's try, or let's look at some question here. Right, I shared with you, I guess, this topic number 5 questions in my guru. Right, so for the first question, if you read the question carefully, it said, an investor just bought a stock that pays constant dividend. Okay, constant dividend. So we know this is our first model, constant dividend, with 2 ringgit per share every year. So this is our D, dividend. And if he requires 10% return, so this is our K, required rate of return, find the IV. Okay, find the intrinsic value of the stocks. Right? And based on the above calculation, state whether you will buy or not the stock. Dia bukan kata buy or sell, dia kata buy if the stock market, if the market price is like 30 ringgit and 10 ringgit respectively. Okay, so if you look at the question, number 1, the question just provide you with dividend and required rate of return without the selling price. Okay, without the selling price. So if this is the case, we're going to use the first formula, which is D divided by K. Okay, D divided by K means the dividend is 2 ringgit and the K is 10%. So 2 ringgit divided by 10%, it will give us 20 ringgit. So this is our intrinsic value, 20 ringgit. And we need to compare this with the respective market price. So the first option, we have 30 ringgit. The second option is, sorry, it's not option, situation. So based on the first situation, the market price is 30 ringgit. So should you buy the stock or not if it's selling at 30 ringgit?
No.
Okay, know why? Okay, the reason is only two. It's either under or over. So by the way, the question doesn't ask you to sell or not. They just tanya, would you buy? Okay, so don't answer you sell. So it's either you buy or not. Yeah. If the question whether you buy or sell, then you can answer sell. But if the question just asks, state whether you buy the stock. Okay, so your answer should be either buy or do not buy. Okay, don't state as sell, right? Because there's some assumption needs to be done. Okay, but anyway, so 20 ringgit compared to 30 ringgit. So this 20 ringgit is the real value. So 30 ringgit is the market price. So 30 ringgit is expensive than 30 ringgit. Okay, so for A, yes, your answer is do not buy. Okay, reason being overvalued. Okay, your reason is only one because it's overvalued. Okay, the market price is more expensive as compared to the real one, the real value. Okay, as for 10 ringgit, obviously, if the real price is 20 ringgit, but market only selling for 10 ringgit, so this is where you buy. Okay, you buy the stock. Why? Because this is undervalued. Okay, undervalued. So if selling price is not given, so the formula is quite straightforward. Okay, like this. Okay, but if you look at second question, okay, this is the extension based on question 1. If the investor wants to sell the stock after 3 years, so now we have selling price of 50 ringgit. So this is the selling price. Okay, we know the dividend is 2 ringgit every year. So we're going to present value, 3 years of dividend, and also 3 years of dividend together with the selling price. Okay, based on this model. Okay, based on this. So meaning we're going to have 3 years of dividend and 1 selling price. Okay, so your valuation will look something like this. So your intrinsic value would be, dividend is 2 ringgit. So it's 2 ringgit dividend. Divided by 1 plus K. So our K was 10%. So it's 1.1. Okay. Plus another 2 ringgit because this is constant. So it means every year the dividend will be the same. 1.1. But for the second year, we need to square it. Plus the third year's dividend, another 2 ringgit. Divide with 1.1 to the power of 3. And don't forget to present value the selling price. Okay, our selling price is 50 ringgit. 1.1 to the power of 3 as well. Remember, our N must be the same during the final years of dividend and the selling price. Okay, it means it's not running from 1, 2, 3, 4, no. So the final year's dividend must equal to the selling price N. So the final two here must have the same value. Okay, and how to determine the values based on the question. So the question specify 3 years. Okay, can you calculate for me? Can you grab your calculator and try to calculate this? $42, exactly 42, or we have cents. Okay, if possible, please leave a couple of decimals, maybe 42.54. Okay. Any other answers, or else I will assume that will be the correct answer. 42.54. Okay, by the way, this is ringgit lah.
Sama.
Okay. So, first glance, to see whether your calculations are correct or not, your answer shouldn't be more than these sum values, meaning you have 2 plus 2 plus 2 plus 50, right? So we have 56 ringgit kat sini. So your answer, obviously, number one shouldn't be more than 56 ringgit because this is based on values original. We are present value everything. So if we present value, we know the answer should be less than 56 ringgit. So 42 ringgit falls in that range. So technically, I assume they're correct. If it's too high or higher than these values, obviously wrong. Or if it's too low of, the value is much lower than 56, then also I can predict your answer might be wrong. But if you get these values, yeah, it makes sense. Okay, 42 ringgit and 54 cents. Okay, so that's how we calculate based on constant model. So for inconstant model, the formula is the same, but the only difference would be your values of D will be different every year. Okay, let's try tengok ada tak question with inconstant. Okay. Okay, question number 9 here. Right, so we have 4 years of dividend, 1 ringgit, 120, 80 cents, and 150. So this is indicators of inconstant dividend because the dividend is different every year. Okay, so automatically we know, okay, this is inconstant dividend, and the formula would be the same as before, as constant. Right, so the investor is planning to sell the stock during the 4th year. Okay, meaning we know our N would be 4, the final N though. And this 30 ringgit is our selling price. Okay, so here they use the terms fair value. Remember, fair value is also known as intrinsic value. Okay, and this is the K, another 10%. Therefore, we have all the information. So this is basically your D1, D1, D2, D3. This is your D4. Okay, consistently with the year 1, 2, 3, 4 again. And the N is 4 as well. So we know this 30 ringgit will be selling price during the 4th year. So substitute this in this formula. The first year is 1 ringgit. 1.1, which is 1 plus K, 1 plus 10% is 1.1 plus 120, 1.1 squared plus 80 cents, 1.1 to the power of 3 plus 150, 1.1 to the power of 4. And lastly, don't forget the selling price, 30 ringgit, 1.1 to the power of 4. So berapa ni? $24.02. 31, yeah, makes sense. 24 berapa ni? 0.02. Anybody got different answer? I can't remember the answer, to be honest with you. I need to calculate. Okay. But if someone can vouch whether the answer is correct, then I don't have to calculate lah. Okay, 24.02. Okay. Okay, clear.
Got the same as 24.02.
Yeah, okay. So we agreed this is the answer lah, 24 ringgit and 2 cents. Okay, just keep it 2 decimals ya. Ikutkan kat sini dia akan dapat 24.0168 0213 kan. So just keep it 2 decimals because this is ringgit and cents kan. So just keep it 2 decimals. So this is an example for inconstant dividend. Okay. So based on this, you can see we use the same formula for both constant and inconstant dividend. Okay. But the rule is you need to have the dividends and you need the selling price. If there's no selling price, then we need to use this formula. But this formula is only applicable for constant. Okay. Because if it's inconstant, we cannot use this one because the D is different every year, right? So we cannot use this D because for constant, we know the dividend is fixed, right? So then we can use this one. So therefore, for any other than constant, the question will provide you with the selling price. Okay. Except the fourth one. For the fourth model, you need to find the selling price yourself. But later on, I will explain how to find the selling price. Okay, but for constant, they might not give you the selling price. If that's the case, you use this one. But 90% of the time, you're going to use this formula. Okay, just to let you know, besides the question asks you to find the intrinsic value, the fair values, the question might ask you to find the selling price as well, maybe. Okay, they can ask you to find the selling price. Meaning, they will give you the current value. Okay, they're going to use the current value. Ataupun they use the word current market price. So don't get confused when we compare against market price. If the question asks you to find intrinsic value and then they give you market price, then we know we need to compare the intrinsic value with the market price. But if the question asks you to find the selling price, like this, so the question must provide you the current value. So the current value, you guna kat sini lah. You don't have to find the intrinsic value. You use the current value here. Substitute everything that you have except the selling price. Then solve it mathematically. Then you can find the selling price. Okay, something like this. The question. if the question doesn't ask for intrinsic value, okay, macam ni dia kata find the fair value, then we know it's intrinsic value. Some question macam ni lah. But this is for growth model like I assume ataupun let's say dia kata what will be the stock price 4 years from now. So meaning this is the selling price, okay, during the 4th year. So meaning if we have this kind of question for constant ataupun inconstant dividend, so D1, D2, D3, D4 you need to find from the question. SP you leave it as it is because we want to find the SP values. So 1 plus K you can find based on the required rate of returns. Okay, so kalau ni ada 4 years of dividend, so N pun 4. But we need to find the DI ataupun the market price based on question. For example, like tadi tu, the market price is this one. Okay, dia bagi current price is 18 ringgit. So this would be our IV. Okay, but again, this is for growth. I just use this as example there. Okay, so it's possible. Okay, the question to ask about something else than IV. Okay, for example, here lah, selling price. Okay, let's move on to the third model. Okay, the third model will be based on growth. Okay, this is based on constant growth. Okay, constant growth model. The formula I use VI juga. Okay, the intrinsic value is based on D1 K minus G. Okay, that's it. That's what I said. To calculate constant growth model is the simplest among all 4 models because it's just have a short formula, just like our formula on top tadi. By the way, if you look at it closely, it's quite similar like this one. Okay, but we have G here. So what does it mean? Okay, so D1 is next year's dividend. Alright, so how to find D1? There are 2 possibilities. Whether the question can give you directly D1, or in order to find D1, you need to calculate based on D1 equals to D0 times 1 plus G. Okay, so what does it mean by G? So before I tell G, we also have K, which is the required rate of return. And G is growth rate. Okay, so to find D1, we might have to use 1 plus G, 1 plus growth rate, multiply with the current dividend. So here, untuk constant growth model, the only trick that you need to beware of is whether the question gives you D0 or D1. Okay, D0 means current dividend, current dividend. Whereas D1, as I said tadi, is a next dividend, next year's dividend. So to differentiate between the two some more, the current dividend usually refers to something that already being paid. Or next dividend usually refers to something yang unpaid, not yet paid by the company. Okay, so they can use the word next dividend, next year's dividend. Okay, whereas for D0, they can use current dividend, recently paid dividend, just paid dividend, for example. So all of those refers to D0. So what's the implication of these two? Okay, the question can use any of this. Okay, so if the question give D0, for example, they use, okay, the company recently paid 20 cents dividend. So you know that's your D0, but the formula needs D1. Okay, so what you need to do in order to find D1, you take that D0, like this, multiply with 1 plus G to find your D1. Okay, but second alternative, if the question said the expected dividend or the next dividend of the company would be 50 cents. Okay, they use that word. So if that's the case, that's already your D1. Okay, that's your D1. So you don't put D1 and then you multiply with 1 plus G anymore, right? Or else that will be D2, okay, the second year's dividend. The question is, the formula is D1. So therefore, if the question provide you with D1, which is the next year's dividend, you just use that figure here without having to multiply with 1 plus G. Okay, so that will be the main difference. So the trick is, not the trick lah, meaning the trap, I can say, is by having this DO, D0 or D1. So what you need to do is basically to read the question carefully. That's the only thing that I can suggest or can advise you. So maybe you can take a look for some example. For growth, constant growth. If you remember, I said earlier, the difference between constant growth and multiple growth is the growth rate. Kalau constant growth, we only have one growth rate. If it's multiple growth, they have more than one growth rates. For example, for question number 3, Wizard Berhad has paid. Okay, this is the keyword, paid. Dividend of 220 last year. So it's already done. Okay, so we can assume this 220 is our current dividend. Okay, D0. And this is the growth rate. The dividend grows at 6% per year. So this is our G. And the rest of the question doesn't specify any other growth rates. So we know this is a constant growth model. So the question asks to find the value of stock today. So this is another term. They use the value of stock today, which is actually the intrinsic value. If the investor required rate of return is 8%. So this is our K. Okay, by the way, when we have this K minus G thing, we assume that the K, the required rate of return, is always bigger than the growth rate. K must be bigger than G. It shouldn't be the other way around. Okay, or else you will have a negative. Sebab formula dia is K minus G, right? So K shouldn't be lesser than G. K will always be bigger than G. Or else you cannot compute the model. Macam mana nak bagi negatif kan? So our assumption, the K must be bigger than growth rate. So for question number 3, okay, so the 2 ringgit 20 cents is the D0. So meaning to find the intrinsic value, you have to find D1 based on 2 ringgit 20 cent multiply with 1 plus G. So the growth rate, don't confuse with 1 plus K. The formula is 1 plus G. So the G is 6%, so 1.06. And divide by K minus G. So K is 8%, G is 6%. So this is how we solve it. It's quite straightforward lah, actually. 2.2 times 1.06 divided by 2%. So here, the value of the stock today would be 116 ringgit 60 cents. Okay, 116 ringgit and 60 cents. So the key is to understand whether this dividend, is it D0, which is based on recently paid, or expected, which is D1. Okay, so based on this question, it's 116 ringgit and 60 cents. Okay, similar like constant and inconstant growth, the question can ask you to find any of the information. They can ask you for K, they can ask you for G as well if they want. Okay, but obviously if they ask you for G, for example, D1 you can find, K will be given, the current value will be given in the question as well. Okay, just like what we have tadi here, right? Anyway, let's quickly tengok question number 4. Jamila is currently considering subscription shares issued by Anggun Ayu Berhad. The share is currently traded RM2, so this is current price. I can put it here as a market price. The current dividend for each is 10 cents. So this is current. They use the word current dividend. So meaning it's paid already. So this is your D0 as well. And grow at 8%. So this is your G, growth rate. And K is 10%. So similar like before, to find your intrinsic value, the dividend is 10 cents. Okay, but you have to multiply with the growth rate, 8%, 1.08. The K is 10%, 0.1, minus 0.08, the G. So 0.1 times 0.08 by percent. So you get a RM 5 ringgit and 40 cents. Okay, 5 ringgit and 40 cents. Okay, so the question asks, besides you calculate, the question asks you, should Jamila purchase the share? Okay, remember, this is your IV, which is the value of 540. So you need to compare with the market price. The current price is 2 ringgit. So should you purchase the share? Justify your answer. If intrinsic value 540, market price 2 ringgit, buy or not?
Buy.
Okay, buy. Why?
Undervalue.
Yeah, because undervalued. Okay, because the market price is cheaper than the real value, so we should buy the stocks. Why? Because reason, undervalued. Kalau kita kata do not buy, because overvalued, that's it. Ada masa lagi tak? Let's try. Okay, maybe ni. Question number 6, Mama Rich Berhad is expected to pay. Okay, this is the word that they use, expected to pay a dividend of 250 next year. So this is your D1. Okay, this is not D0, this is your D1. So when we calculate later, we don't have to multiply this with 1 plus G anymore because this is already our D1. Okay, so the required rate of return is 12%. So this is our K, required rate of return. And they will grow constantly at 6%. So this is our growth rates. So compute the value of Mama Rich common share. Okay, the same formula, but this time around, this 250, you don't have to multiply with 1 plus G because this is your D1 already. Okay, so how to differentiate, how to distinguish? They use the word next year and expected to pay. So this is not yet happening. Okay, this is next year's dividend. So this is your D1 already. So K minus G is 12 minus 6%. So 250 divided by 6%. So it's RM 41 ringgit and 67 cents. Okay, 41 ringgit and 67 cents. Okay, very straightforward. Okay, that's why I said for constant growth, we have the simplest calculation because the length of the formula is very small, very limited. Maybe last one, we covered most of it. Okay, maybe last one. To question number 7. Okay, Bora Bora Limited stock is currently selling at 50 ringgit per share. So this is current price. The expected dividend for next year is 3 ringgit 20 cents. So again, this is your D1. Okay, because they use the word expected dividend. Okay, for next year lagi. And have a constant growth. This is the K. So dia tanya, what will be the growth rate? So meaning we need to find G. We need to find G because G is not given. So therefore, automatically, if G is not given, the VI, the intrinsic value, we have to use the current price. Okay, so meaning this 50 ringgit will be our so-called intrinsic value or the current price. This dividend 320 is already our D1. Okay, you don't have to multiply with 1 plus G. The K is 15%, but the G is unknown. Okay, so what would be the G? So since G is growth rate, so our answer should be in percentage. Berapa? So mathematically, you know how to solve, right? So you just multiply 0.15 minus G with 50 ringgit. So 50 minus 15, then you get 50G. So bring this 50 times 15 cents to this side, knock off the negative values, and then divide back, then you get the rate. Okay, or times 100. Yeah, 8.6%. Yeah, must be percentage because growth rate, if you refer to the previous question, pun dia guna percent, grow at constant rate of 6%. So growth rate must be in percentage. Okay, so that's our first three models. Okay, most of the time, this one seldom lah, they will ask you if with no selling price. Okay, most of the time, we just focus on these two je. Okay, constant and inconstant dividend model based on this formula. And for the constant growth, and only for constant growth, we use this formula. Okay, and as I said earlier, the question may ask you, besides the intrinsic value, the VI, they may ask you to find the selling price. They might ask you to find the G or even the K, right? It's not necessarily always intrinsic value. Okay. So we left with one final model. So I will explain about that model in our meeting next week. She's apa tadi punya? Inconstant model. So inconstant model, you will see later, we have 3 steps, and the final step is actually using this first model again. So this model, yang number 2 ni, will be utilized for 3 models actually. Okay, constant, inconstant, and also inconstant growth. But for the inconstant growth, we have additional steps to do before we finalize with this final step. Okay, I will explain in our meeting next week. Okay, so I think I'm gonna stop here for today. All right, thank you very much. As always, I will share the video via my guru, the link, the YouTube link tu in my guru. As I said juga, you can check based on the link or the playlist in the YouTube channel that I created tu. The previous topics I dah sort in that particular folder for investment portfolio. But the recorded sessions that I share with you might be different with the one dalam playlist, because playlist tu usually, because I have few classes, right? So I just choose one every week randomly. Sometimes might be from this one group B kan. Sometimes I may use group C punya video dalam tu. So if you want to look other groups, sometimes I might use different example maybe untuk, you know, to illustrate the calculations. You can check other videos as well in the playlist. All right, and that playlist I sort according to the topics as well. Okay, so thank you very much. See you guys next week. Okay. Thank you.
Thank you, sir.
Okay, sir. Thank you, sir.
Thank you, sir.
Okay.